Berlin's invisible credit engine. It never announced itself, never appeared in headlines, and never asked for attention. Yet beneath Berlin's steady economic rhythm, a vast engine of credit worked relentlessly, shaping outcomes long before politicians or markets reacted. It was invisible by design, and for years, that invisibility was mistaken for safety. To understand how Germany built a financial mechanism so powerful yet so quietly exposed, we must return to a system rooted in stability and trust. Germany's economy prized precision, discipline, and continuity. Its banks were not known for spectacle or excess, but for reliability. Credit flowed not through dramatic gestures, but through layered institutions that connected industry, regions, and the state itself. Today, the same architecture still underpins Europe's economic core, often unnoticed until stress reveals its shape. The story begins with a network rather than a single bank. Public lenders, regional institutions, and industrial financiers formed a lattice that delivered credit where markets alone would not. Small manufacturers relied on it. Infrastructure depended on it. Entire regions grew around its steady pulse. This was not speculation-driven finance. It was relationship finance, built on long horizons and mutual dependence. Because it worked so well, few questioned its scale. Credit accumulated quietly, distributed across balance sheets designed to absorb stress without drama. Risk appeared dispersed, almost harmless, but dispersion can be deceptive. When systems grow complex enough, danger does not disappear. It becomes harder to see. Inside the machinery, subtle shifts began to appear. Margins thinned, guarantees layered over guarantees. Exposure to global markets crept in through trade financing and foreign subsidiaries. None of it alarming on its own, all of it rational. Yet together, these adjustments began to alter the nature of the engine itself. The first warnings came not from losses, but from dependency. Industries structured their survival around continuous access to credit. Municipal budgets assumed rollover would always be available. Banks trusted that the system would never be tested all at once. That trust, deeply ingrained, became the system's greatest vulnerability, because when pressure eventually arrived, it would not strike a single institution. It would move through the engine itself, challenging a structure that had never been forced to prove how it behaves when invisible strength becomes visible strain. And in Berlin, the realization was beginning to form. The engine that powered stability might also amplify risk. All it needed was the right moment to reveal itself. The strain revealed itself gradually, not through collapse, but through friction. Credit approvals that once moved smoothly began requiring additional reviews. Renewal terms tightened quietly. Regional banks started asking questions they had never needed to ask before. To the outside world, nothing appeared broken. Inside the system, however, the invisible engine was beginning to labor. The cause was not a single shock, but convergence. Global trade slowed. Energy prices shifted. Export demand softened just enough to affect cash flows across Germany's industrial base. The credit engine, designed to support long-term relationships, absorbed the pressure at first. Guarantees compensated for weak quarters. Public lenders leaned in where private appetite hesitated. The system did what it was built to do, but each intervention layered more dependency onto the same framework. Inside regional banks, risk officers noticed a subtle transformation. Balance sheets grew heavier with exposures tied to the same sectors, the same suppliers, the same municipalities. What had once been diversification through proximity now resembled concentration through design. If one segment faltered, others would not be far behind. The engine was still running, but its tolerance for shock was narrowing. Municipalities felt it next. Infrastructure projects assumed continuous financing at stable rates. When terms shifted, even slightly, timelines slipped, budgets tightened, officials postponed maintenance, deferred upgrades, and leaned harder on the credit relationships they trusted most. Each delay seemed manageable. Together, they formed a feedback loop that fed directly back into the banking system. At the federal level, policymakers monitored the data with increasing unease. Aggregate numbers remained strong, masking stress accumulating below the surface. Germany's financial identity had always relied on resilience through structure, yet structure can hide stress longer than markets can. By the time pressure becomes visible, it is often already embedded. International counterparts began noticing inconsistencies. German institutions, long viewed as anchors of stability, became more selective in cross-border lending. Trade finance slowed. Settlement windows widened. These were not signs of weakness, but of caution. And caution, in a system built on steady flow, changes behavior everywhere it touches. Inside Berlin's policy circles, a realization took shape. The invisible credit engine was not failing. It was becoming essential in ways that left no margin for disruption. Its success had made alternatives unnecessary. Its reliability had crowded out redundancy, and redundancy, once lost, is difficult to rebuild quickly. As pressure continued to build, one question hovered over every internal briefing. What happens if the engine is forced to slow all at once? Not because of mismanagement or excess, but because the environment no longer supports uninterrupted motion. The answer had not yet arrived, but the conditions for it were forming quietly, precisely, and entirely out of sight. The test arrived without drama, carried in a shift so ordinary it almost escaped notice. A large industrial borrower requested a routine extension on its credit lines, citing delayed payments from overseas partners. Under normal conditions, approval would have been automatic. This time it wasn't. The request moved upward, triggering internal reviews that revealed how many similar extensions were already embedded across the system. One delay became many, and many delays began to look like a pattern. Inside the regional banks, concerns sharpened into tension. Risk models showed rising correlations where independence had once existed. The same industries were straining simultaneously. The same municipalities leaned on the same guarantees. The invisible engine had synchronized risk without intending to. What had been designed as resilience through relationship now functioned as amplification through connection. Executives convened quietly. They debated whether to continue absorbing stress or begin forcing adjustment outward. Neither option felt safe. Pulling back credit risked accelerating slowdown across industries that depended on continuity. Maintaining it risked exhausting buffers that were never meant to absorb a system-wide pause. The engine had no obvious off switch, only gears designed to keep turning. As credit terms tightened incrementally, businesses felt the change. Manufacturers delayed expansion. Suppliers shortened payment cycles. Hiring slowed, then paused. None of this registered as crisis, but together it altered momentum. The economy did not fall. It stiffened. And stiffness in financial systems often precedes fracture. Berlin's policymakers watched the shift with growing urgency. Data still looked solid, but behavior told a different story. The engine was compensating for weakness by concentrating exposure even further. Public guarantees expanded. State-backed institutions carried more weight. The system was becoming stronger and more fragile at the same time. International markets began to adjust their assumptions. Germany was no longer just exporting goods. It was exporting stability through credit. When that credit grew selective, ripple effects followed. Supply chains recalibrated. Financing costs rose elsewhere. Europe's economic core was quietly transmitting stress outward. Inside the engine, one final realization took hold. The system could not correct gradually without coordination. Left alone, each institution would act defensively, tightening just enough to protect itself while increasing pressure on the whole. What had once been invisible strength now demanded visible management. The question was no longer whether intervention might be needed. It was whether Berlin would act before the engine stalled on its own. And as pressure continued to build, the window for subtle adjustment began to close. The response came not as a rescue, but as a recalibration. Berlin moved quietly, coordinating across public lenders, regional banks, and federal agencies to realign the flow of credit without signaling alarm. Guarantees were adjusted. Liquidity facilities expanded with conditions. Timelines were lengthened selectively, allowing pressure to ease without forcing abrupt withdrawal. The engine did not stop. It was retuned. The effect was immediate but subtle. Credit continued, but under tighter alignment. Risk was redistributed rather than denied. Institutions that had absorbed disproportionate exposure received support in exchange for transparency and restraint. The system began to breathe again, not through acceleration, but through balance. Europe took notice. Germany's approach avoided spectacle, but it altered assumptions. Stability did not require dramatic intervention, only recognition of interconnected strain. The invisible engine had revealed its limits, and in doing so, it redefined how strength could be managed without crisis. Inside Germany, the episode left a quiet mark. Policymakers acknowledged that resilience built on continuity must still prepare for pause. Redundancy was restored, oversight sharpened. The system regained margin, not by growing faster, but by allowing space. The engine remained invisible to most, but those who understood its workings carried a new awareness. Stability is not automatic. It is maintained through attention to what cannot be seen until it strains. Berlin's invisible credit engine did not fail. It evolved. And in that evolution, Europe learned that the strongest systems are not those that never slow, but those that know when slowing is survival. Sometimes the smallest shift in perspective becomes the beginning of a new future.